Well, hello there, Mark Yagi back here, and I am in Australia now. A lot of people want to know where I'm going, so I'm making this video from Australia. Just got here from the Philippines. I'm on an around the world trip and I'm trading around the world, so maybe that's interesting for you, maybe it isn't. But listen, last week I put out a video, this video right here, about the Bitcoin approvals of the 11 exchange traded funds that had just come out. And so I said, hey, here's a speculative trade on if you want to play this Bitcoin thing using a stock called Microstrategy. And so we did that. Now take a look at this chart. This is a chart of Microstrategy since I made that call, right? So it's done nothing but go down. It was a sell the news event. And so everybody was buying into the rumor and Bitcoin ran up and so did Microstrategy. And then since then, Microstrategy has sold off and so has Bitcoin. Now, is that the end of the world? Well, we don't trade covered calls or even any stocks for a week. That's not our thing. We're not day traders, we're not swing traders, we're not position traders. It's not what we do. We buy a good base position, we sell calls against it for income, and that's what we do. And there's a lot of income on MicroStrategy. We took a shot that was gonna go up, it didn't go up. So here's how you repair that trade. Now, when we do this repair, it's gonna be using a synthetic. If you don't know what a synthetic is, either watch some of my other videos on the channel about synthetics, or I will just tell you that a synthetic is a replacement for your base position, okay? And so what we do is we buy a deep in the money call at around a 90 delta, and we go deep in the money to be able to control a certain amount of shares with less money than if we had bought the stock. So we go deep in the money, it acts like the stock because it's deep in the money, and if the stock goes up, we've got a lot more shares, and we have certainly a lot more shares to make income from while we wait. So that's the premise of this. We take a losing trade, it's losing only for this week, but it's down for sure. And then we'll add to it a synthetic position, which I'm gonna show you exactly how we do that. Last week, this is the analysis that we did on the stock. The stock was $541.45. We got $16.50 for the call. Our strike price was out of the money at $565. We did 1,000 shares. I know it's an expensive trade, but it was a hypothetical. And that's $524,950, meaning we had a basis in the stock of $524.95. It didn't go up, so now what do? Do we sell and say we suck? No. We're not in this for a week. This was a 9-day trade. We're in this for the future, for the income. So if you have that mentality, you realize this isn't a capital gain strategy, this is an income strategy. Just like when you go buy a house for $300,000 and you start renting it out for $3,000 a month, you don't care that it fluctuates in value as a house, you care that the income is being paid. Same thing with this. So it's a little bit of a mind twist for you. So here's how we're gonna repair the trade, which is an important thing to learn, trade adjustments and repair. And we're also gonna do covered calls, but we're gonna do them using synthetics, and we're gonna blend the two. So it's a little bit of mystery math that I'll put together if I can for you so that you understand how we're doing it. And so here's that modified trade that we're gonna do. We have 1,000 shares of the stock already, or 10 contracts as an equivalent, and because every contract is worth 100 shares. And so now what we're gonna do is we're gonna go out to April, which gives us about 4 months, right? Today is January 17th, it's gonna give us 4 months. We're gonna go out to April and we're gonna look for the 90 delta. Well, we don't have a 90, we got an 89 and a 91. So the 91 delta is the 310s. So we're gonna look at those 310s, and those are trading right now between 180.55 and 188.55. Pretty big spread, but the market's closed. So we're gonna bisect the spread right in the middle, 184.55 for the 310 strike prices for April. Doesn't really matter to us at this point for calculations when it expires, but just so you know, you got 4 months on this trade. That's a good amount of time to make income. Here's the options that go out 9 more days, because now we're looking at next week. And so for these, what we would do is we would look at let's call it the 510s. A little bit out of the money and a little bit less than the 565s, and certainly less than the basis that we have in those last week's positions at 524. But I think it's a good spot to be because it's between 1255 and 1370. So let's say we get somewhere in the middle of that, like let's call it 13 bucks. Okay, just to round the number off. Here's how that calculation works out. The underlying stock price right now is 482. We're gonna buy the synthetics for 184.55. Remember I just told you that? And now we're gonna sell those calls for $13 for next week, the nine days out, okay? The strike price is 510, and we're gonna buy 20 contracts, or 2,000 shares would be the equivalent. Well, that means we're gonna bring our basis down to 171.55 on the synthetic position. We're gonna pick up $13 in juice. That's gonna give us a 7% return right? Status quo, and that's if the stock doesn't do anything. And if it goes up, then we're going to get some more, as I'll show you here on this calculation. Okay, now in order to be able to kind of blend the two things together, because we're basically two different kinds of position. One is a stock trade, one is a synthetic trade, and they're really apples to oranges until it's all over. So let me try to explain to you the middle process. What we're going to do is on that trade that we did a couple of days ago, the call is only worth $1 now. Remember, we got like $16.50 for it. It's declined in value because the stock has declined. It's worth $1. We're going to buy it back at $1. And we're going to sell the new calls on that position, position A, let's call it, the 1,000 shares, for $13, just like we're going to do on position B, which is the synthetic position, okay? So that lowers the trade basis on trade A from $524,950 to $511,950, okay? So that you're going to see that right here. And I broke it down into a little spreadsheet so you can understand. So we've now got $511,950 into position A, and then we're going to do position B in a second. So let's just analyze position A. If now we go another 9 days and position A doesn't do anything, the stock doesn't go up or down or sideways, it stays at 482, we get back $482,000. Now we put in $511,000, so we'd be losing a total loss of $29,950. But we're not in this for 1 day or 1 week or 9 days. We're in this for the duration. But I'm just got to be honest here. We're going to be down $29,950 on that trade. But if the trade goes up for 510, since we made the adjustment on that trade, we're only going to basically lose $1,950. That's not that much on a $700,000 trade or a $511,000 trade it is now. All right, on B, which is the synthetic trade repair, okay, and this is what I believe everybody should understand synthetics, because they're powerful tools for trade repair. They're powerful tools for trade adjustments. And if you don't know them, you're missing a big tool in your toolbox. Anyway, so on this one, you paid $343,100. I showed you that on a prior screen. So at expiration, it's going to be worth $369,100, which means if it does nothing else, you end up making $26,000 on the trade. And if it goes up to 510, you don't make anything over the 510, so we cap it out at $399,100. And that means you make $30,000 on that second part of the trade, trade B. So if the stock goes all the way up to the strike of 510 or higher, we end up making $28,050 on the trade, or $9.35 on a trade that's gone down a lot. Pretty good way to repair a trade, right? And if it just stays the same, we end up losing $3,950 total, or $1.32. Again, pretty good from a stock that's gone from $545 to 482. That's the power of income from covered calls. And so that's, if you just do the one trade, it looks like a failure. And if that's what you're doing, I don't think you should do covered calls as a spread trade. I don't think you should do them as a 1 week trade. I think that's very speculative. It's all part of a strategy, and the strategy is an income strategy. You buy the base position, you sell calls against it for income, you lower your basis, and that gives you a lot more options. This is a way that we use the synthetic on a covered call, we use the stock on a covered call, but we use the synthetic to do a repair of the trade, making the trade, well, break even to profitable. Hope you liked that video. See you on the next one.